Okay, good morning, and thank you for joining this panel. Being conscious of time, we will start. First of all, I would like to introduce our panelists. Solange Berstein, Chairwoman of the Financial Capital Commission in Chile, Juan Pablo Córdoba, CEO of Nuam, Pablo Riveroll, Portfolio Manager of Latin American Equities from Schroders, and Jorge Valencia, Chief Business Officer of Santander UK. Thank you very much, and welcome to this panel where we will discuss about the future of Chile's capital market, which is central for our resilience, our economic resilience and growth. In the recent years, we have seen a sharp decline in market depth and investor confidence. Since capital gains were introduced, trading volumes dropped, and tax revenues fell far short of expectations, just 11 billion out of the 90 billion originally projected. This has hurt liquidity and limited access for mid-sized and emerging firms. We are also facing fewer intermediaries, reduced institutional investment, and ongoing barriers for small and mid-sized companies looking for financing. If we look to the UK's market, the Financial Services and Markets Act of 2023 reminds us that regulation should not only protect, it must also promote innovation, competition, and confidence. Our challenge is to rebalance oversight and development to unlock growth without compromising stability. Today's panel is a chance to explore how can we do that by learning from global best practices and unlocking potential to build a deeper and more dynamic market. Each of you will have 7 or 8 minutes to share your thoughts and reflections with us, and then we will pass through a Q&A session. Solange, the floor is yours.
Thank you very much, and thank you everyone, and of course for the organizers of this event. So it's very good to be part of this panel and share our view as regulators of the financial sector in Chile. And indeed, we have been working recently over the last 3 years, or even more than that. Since we are CMF, we have an explicit mandate in terms of capital market and financial development. So it's not just something that we are working for because we think it's important, but it's because it's on our mandate. And indeed, what we have been doing recently is working on a roadmap for the future years in order to achieve what we think would be a more developed capital market and better services for the Chileans and of course, the well-being of everyone, no? And in that terms, when we think about it, we need to think about supply and demand side of financing. And in that sense, when we think about both sides, when we think about regulation and how we enhance the capital market in order to finance projects, we need to think about the investor side in terms of what do they need in order to have confidence in the market. And on the other hand, we do need to think about issuers and what do they need in order to trust and to find the financing that they need for their projects. And all of that needs also roads, it needs an infrastructure to make this all possible. So we have been also thinking about how to improve the way in which trading platforms work and market infrastructures in general. Also, there's a role for financial advisors, for auditors, risk rating agencies, and others, of course, that make sure that the information that's available to investors it's reliable. And supervisors and regulators, we have to oversee all of this and somehow have the regulatory environment that allows for the development of capital market. Also makes it resilient, transparent, with investor protection. So, if we go to the next slide. Thank you. And think about it. We issued a policy paper last year, and indeed, 3 years ago, or yeah, I think it was 2 years ago, when I announced that we were going to issue this policy paper, where we were going to define what is financial development for CMF and the way in which we will be working on it. And we issued that paper. the document, and then we started work in terms of receiving proposals from the private sector in order to have that on board in the design of this roadmap. And then we've also been participating actively in different international forums to have that experience as well. And we have focused on 4 thematic pillars. The first one is on corporate governance. We did receive a lot of proposals on that end, and if we can think about the 4 main topics around it, and we can talk about them a little bit more further in the panel, but regulation in terms of simplifying regulation, make it easier for different participants, issuers, and also investors, and how we do have the balance there, the right balance, investor protection, transparency, technological innovation, and how technological innovation could help also to have a better corporate governance. There, the role of institutional investors also is quite key in order to promote corporate governance in the projects and companies where they invest. So there's a lot to do on that end. Then the second pillar in which we have been receiving proposals and have been working on is platforms, infrastructures, and market depth. And in terms of structures, we did have also proposals on that end. And some of the are the need for further make it market. I think the mic is not working very well, but internationalization of our market. We have been working a lot with the central bank for many years now in order to make the peso as an international currency and how to eliminate frictions for that to be possible, but also how investment vehicles are better designed for international investors to participate in the different sectors of our economy. Technology and transparency are also there, liquidity, derivatives, regulation, market makers are also something that we have been working on. In terms of funding, just the minister was talking about that, how important it is in order to these companies to be able to scale up, and I've been working on that as well. And for that, are in terms of proportionality, in terms of the regulation for issuers to participate in the market, financial vehicles again, in terms of which are the best instruments for small and medium-sized companies to be able to access the market, financial conditions. There, the credit registry, the new credit registry is going to be very important because better information and more information about how companies are complying with their commitments make them possible to have financing in better conditions. Financial education, it's also very important. Many small and medium-sized companies do not know how to access the market, do not know how to design the financial instruments and products to get financing from the market. And then the fourth topic is promotion of savings. That is also very important for our country. We did have pension withdrawals a couple of years ago, and we do need to boost savings, and how to do that is also something that we have been working on. And again, it comes out financial education in terms of how to promote saving and to have that investors really know on what type of investments they are engaging in. Technology and innovation makes it possible, but it makes it possible on the one hand, but on the other hand, it makes it more risky or more risky instruments available for retail investors. And how do we do that in the right way? Incentives, eliminating frictions, and again, coordination between different regulators is something that has come out. So there's a lot that we have been working on. The CMF must balance market development with our two mandates, financial stability and market conduct. It's not possible to have financial development if we do not have financial stability. So it's a precondition somehow. And market conduct is as well. So transparency and investor protection, it's quite important in order to have that development to be sustainable in time. Achieving these conditions will ensure deeper market. So we have been establishing a dialogue with the private sector in order to have this roadmap and to have an agenda that will really enable substantial and sustainable progress to benefit our Chilean citizens. And this will converge somehow towards a more developed financial market. That's what we are looking forward. And we will publish a paper in the March next year, if everything goes as we have already planned. But this initiative needs the participation of everyone, and we're very thankful for all the proposals and the participation also in the workshops that we are carrying out. So thank you very much for all the ones that maybe some of you are present here that have contributed to building this way to the future. So that's it for now.
Juan Pablo?
Thank you, Silvia, and thank you for the organizers for inviting us to participate in this panel. I've chosen a few words so that if you leave with anything from my intervention are a few words. And the first one would be nurturing. That's the key word that I want to, and the key message that I want to convey, and is that capital markets need nurturing. And all of the comments that I will make are targeted to nurturing the capital market and the capital markets that Chile needs for precisely the coming years. I think that to start on a positive note, I would say that there is tremendous consensus in Chile about recovering economic growth. And the good news is that economic growth and the type of growth that we needs a robust capital market. So I think the two conversations go together. Growth and dynamic capital markets go together, and then I guess this one, yeah. The capital markets needs nurturing. The good news is that we have a strong starting point, as Solange was just mentioning. I think Chile has a tremendous tradition of strong institution, good economic management, good regulation, good supervision, and something that is very important that was also mentioned before is a sophisticated market participants. This is a good and sound starting point for the next stage of the development of the capital markets in Chile. Then the next word that I want to leave you with is ecosystem, is that a capital market is not just about a single part of the capital markets, but we really need to be aware of all of the pieces in the ecosystem. And it's important that all of those pieces work together, work in tandem, and create what I like to call economies of scale. The capital markets, to have a robust capital market, you need economies of scale, and these economies of scale are built. Every single piece of the puzzle is working correctly. So issuers, brokers, institutional investors, retail investors. What are retail investors doing? I mean, today retail investors are investing in crypto. Where are we in crypto in this conversation? So
That's the next panel.
The next panel. So what are we doing to attract retail investors, foreign investors, market makers, analysts, advisors, etc.? All of these things are part of this ecosystem that needs to be fostered and build economies of scale. And the message in economies of scale is we may not be able to have in a relatively small country every single piece working exactly as we want it in the main markets in the world, but we can use some of the foreign assets to build, for example, economies of scale in the local asset industry. The other element that I would like to leave is not only demand and incentives are key. So, for example, right now we have a tremendous opportunity in Chile with the pension reform. What will be the role of the pension funds and the pension system moving forward towards the capital markets? We heard about the needs for infrastructure financing, energy transition, mining, the scale-ups of certain SME companies, etc. Will these solutions be brought to market? Will they be private? So the role of pension funds will be very, very important. And having the full, I think we need to focus in ensuring that the full value chain of the capital market works, not just the I guess, an efficient system for the large and liquid companies, but we need a small and medium cap market. We need venture capital. We need seed capital. So all of the value chain needs to be. We need to ensure that it works and it works fine. And then incentives are key. Right, so there's a lot of discussion. I know Silvia wants to touch on this issue about the capital gains taxes and how that has not only created a disincentive to participate in the market, but it has created a distortion in the market between the cost of capital for larger firms and smaller firms and the cost of capital for venture capital domestically. So capital gains taxation is a big issue that we need to discuss and to create better incentives and a level playing field in terms of the cost of capital. And then finally, the other point that I want to make is operational efficiency. In today's world, where capital is global and the competition is global, we need to make sure that our local capital market is as efficient as possible, the most efficient capital market that we can build in a country like Chile. And this conversation is mostly micro. I'm an economist by profession, but every time we talk to economists are always talking about macro, which is great, necessary condition, but is not the sufficient condition to create a local capital market. The discussion about market efficiency is a micro conversation, and every single minute detail matters. No, and I just want to make some comments like automation, taxes, tax reporting. So you say, okay, there's no tax, but you still need to comply with certain tax processes that make it impossible for people to comply. That is a disincentive to the market. How our accounts are set up. Things like settlement cycles. Is it T0, T+1, T+2? For which markets? Are all markets synchronized or not? Things like time discrepancies. If we close the central bank settlement at 4 p.m., is that good for international investors or not? So very, very specific issues that may not be so relevant for many of you, but they are very relevant for constructing market efficiency. And I think that today we need to have the most competitive capital market Chile can build in order to compete globally. And things like CCPs, we've been discussing with Solange and the CMF, the role of CCPs in terms of the cost of capital to the private sector, the cost of capital to banks is very important, and CCPs are a critical part of this conversation. Do we have the right setup of CCPs in Chile? Do we allow netting? Do we maximize the netting efficiencies in the market? So definitely there's a lot of things to be done there. We can eliminate some self-imposed, let's say, restrictions, like, for example, the foreign assets. I'm a true believer Mexico has done a great job of creating a huge market domestically of international assets. That helps to build and develop the capital market. That creates an economic activity in the local market, that creates taxes in the local market, and is a very efficient way for local investors to access global investment products. So that's another conversation. And then I would leave a last one here for Solange, with all due respect, in terms of innovation. I think the CMF has done a great job of inviting, I think, the whole industry to make proposals. But you guys have I guess, a very difficult challenge, which is in innovation, we need to be quick. I think the market will always wants to have things done immediately. But when you're innovating, we have to allow for mistakes, right? You open up the door for something, it's very likely that we're not going to be successful the first time around. So we need to be able to very quickly adjust the regulation. And that I think is a tremendous challenge. With all due respect, I think it's a very difficult job you have. But to have a dialogue with the private sector is very important in terms of evolving regulation to allow innovation. So on a final note, just to go back to the optimism, I think we have the right timing, the right momentum, focus on economic growth. Capital markets are key for economic growth. We have a great starting point, and I think that if we work together, as also the minister mentioned before, private sector and public sector, I think we can build the capital market that Chile needs for the future. And of course, coming from Nuam, we would like to contribute in this conversation from what we're trying to build, which is to build economies of scale in the local capital market through the regional integration with Chile and Peru. Thank you.
Thank you, Juan Pablo. Jorge?
Well, thank you very much. Thanks for the invitation. I'm going to try to to be brief on my comments, but I want to start with a sort of a reflection of what I've seen of the evolution of the Chilean capital market for the last, 20 years now. We tend to start, when we have the discussion about the Chilean capital markets, we tend to start with the supply. So how can we make it easier for SMEs to issue a new bond? How can we make it easier for them to list and so forth, right? But the problem if we focus too much on issuers, and it's like I tend to see, and this is why I put this picture here, because a capital market with focus on issuers is really like a bulletin board. We really need to focus on investors, right? If we have money to invest, issuers will come, trust me, right? In Chile, at some point in 2010, the market cap of the Chilean stock market was like 160% of GDP. It went as low as 58, 59% in 2023. Now it's up a little bit. It's slightly over 63, 64%. But this is exactly the problem. We have always focused all of our efforts in making it easier for the investor to try to look for money, but there has not been investors willing to put that money to work in those projects, right? The concentration of the Chilean market is huge. We still have significant amount of the money concentrated in pension funds and institutional investors, and those are the real drivers of the market. And what they really do is that they have helped develop pockets of the market where they are able to participate more. So, for example, if you look at what happens with the Chilean asset allocation of a pension fund compared to the average OECD, well, the Chilean pension funds have a lot of money invested in Chile, but in fixed income, right? So guess what? The fixed income market is done well, it's resilient, it's relatively liquid, it works okay, and there are good bond issuance and so forth. But what has happened with the equity markets, or what the extremist alternatives? There's basically no alternative, no local alternatives, right? So there is a lot to be said about this, and there are a lot of efforts to be done around incentives specifically for this. So going back to Silvia's concern about how do we treat big companies that issue equity in the stock exchange vis-a-vis what's a tax treatment of relatively illiquid smaller companies, well, it's different, right? What if we do like a private deal? That has a different tax implication, and that keeps the attractiveness of those investments relatively low. So this is a huge focus. And it's also important to understand that this is driven by regulation. Pension funds will do the best asset allocation, and they will manage the money in the best way possible given the guidelines that they have. We cannot go and say, you know what, with these regulations, you go and lend money at a lower rate to a specific company. They're not going to do that because they have a fiduciary duty. They have to manage their money, the money as best as they can. But we can put specifically limits, or we can direct the allocation around this set of goals. So this is an important topic, and especially important given the discussions that we are going to have in the next year or so around target date funds and around international benchmarks. This could be really dangerous if it's not done correctly, right? It's kind of public that I'm not a very good, I don't have a great opinion about target date funds. Actually, I'm not very popular either because I said it here last year and it ended up happening, but whatever, this is what it is. I think target date funds are a bad idea, but it's already going to happen, right? But if target date funds plus a benchmark that is agnostic to the local capital market ends up happening, that could be really, really bad and really dangerous. Look at what happened just with one example about regulation and how important it is. 10 years ago, there was a very relevant market on Chilean small caps. There were a lot of local funds that were investing in the asset class. The asset class was growing and so forth. Over the last 3 to 5 years, the pension fund regulator thought it was a bad idea that the pension funds would pay fees for external managers on a local asset class, like small funds. And that industry has shrinked significantly. The market has shrinked, and basically the asset class is disappearing. So we have to be very conscious that regulations around this is extremely important, will have consequences, and the transition from the current portfolios that we have to the whatever portfolio ends up resulting of target date funds will have a significant impact on what's the end of the Chilean capital market. So I know it's not the CMF that will regulate that, but I'm sure the CMF has to be extremely involved because of the consequences that it's going to have to the Chilean capital markets. And those are my comments. I mean, I really hope for a bigger capital markets. The main idea of a capital market is that people are there to invest and to get decent returns. I don't expect anyone to go invest for charity. But incentives are what's really going to drive the growth. And we have a very good opportunity right now with the changes that are happening with the largest investor in the country to help develop this market. That's it. There you go.
Thank you.
Thank you. And thanks again for the invitation. Very happy to be here. I'd like to give a bit of focus and a bit of an understanding of how us as institutional investors, large institutional investors in emerging markets and in Chile, think about the market, think about liquidity, and what's the current state of events. When we look at the LATAM market, Chile is 7% of the benchmark. For emerging markets, it's 0.5% of the benchmark. Now, when we look at the exposure per sector, we can see Chile is relatively well diversified. It has several sectors represented in the market. It has banks, it has consumer, it has commodities, it has utilities. You cannot say the same for many of the other markets. So on paper, it is broad and it is deep. Now, when it comes to types of investors, of institutional investors within emerging markets, I think we have 3 types of products that would invest in Chile and in LATAM. One is large emerging market funds. Our emerging market fund, for example, is north of $30 billion in assets. Concentrated emerging market funds, average size probably $5 billion. And LATAM funds, which are relatively concentrated, let's say a target capacity of about $1 billion. Now, when we're looking at can these funds invest, this picture changes somewhat. So if you think about an emerging market fund that has 30 billion under management, a minimum position probably would be 50 basis points. No? That would be a fund that has about 100 positions. There's active share consideration, so you wouldn't want less than 50 basis points as a standard position. That's $150 million. Now, the way we think about liquidity, and our risk team thinks about liquidity, is let's assume that you can take about 20% of the daily liquidity in the market when you're trying to buy a position or sell a position. And let's calculate how long would it take to go in and out of positions. 20, 25% depends. Obviously, when things go bad, that window is very narrow. So 20% can even be a bit generous. If you take 20% of 20 million, that's $40 million that you can buy, $4 million that you can buy per day. So if you're building an $150 million position, it would take you about 37, 40 days to buy, two calendar months to buy a single position. To sell, if something goes wrong, it would take you, if you're lucky, a couple of months, could be much more than that. So and the alarms start to ring in our compliance and risk departments when you start to accumulate illiquid positions. Now, if you're a concentrated emerging markets fund, $5 billion, you might aim for an average position of about 1%. That's about $50 million. So it would take about 12, 13 days to buy a $20 million position. If you have the position, the liquidity to about 10 million, then that becomes about 30 days. If you go down to 5 or to 1 million, then the days to buy and to sell become very large. Alarms start to ring. You start to get quite limitations in terms of purchasing. And for an average LATAM fund, if you want, again, a 1% position, that's about $10 million. 20 million of liquidity, it would take 2.5 days to buy. 10 million, it starts to go to 5 days, 10 days, and the majority of the market, which is in between 1 and 5 million, would take you 20, 30 days to buy or to sell, which again, liquidity starts to become a real issue. Now, when we look at the benchmark that I was mentioning for LATAM, the overall opportunity set is about 250 companies, out of which about 200, above 200, have more than $1 million trading liquidity. That, as you can see in the chart, goes down quite quickly. The more important thing, however, is that Brazil, which was 57% or 60% of the overall benchmark, when you restrict the liquidity to, say, 20 million on the extreme, becomes about 70%. 77, 78% of the market, depends how you calculate it. Chile goes from 7 to 4%. So we start to see even more concentration in Brazil and against other countries, including Chile. Now, how does it look within a Chile portfolio? If we build country sleeves for our funds. So again, on the fully liquid, no requirements on liquidity, I can build a diversified portfolio. I have access to great pockets of the economy, like banks, like consumer discretionary, like utilities, and a bunch of others. As I start restricting it, if I had a hard cut of 20 million or more, I have 2 opportunities, out of which one is, these 2 are SUM and LATAM. So am I really getting domestic exposure, relatively low risk exposure to the domestic economy? It's very, very hard. So I need to take material liquidity risk. And we've faced this. There's some fantastic companies, fantastic banks that we've purchased at a time. And eventually the liquidity threshold becomes very large and we need to take that risk. So I think that is the current challenge. I think that the main issue is liquidity. On the question of demand or supply, I think the demand from us would be there if the liquidity was there. How do you get greater liquidity? It's a bit catch-22. You need more, better liquidity, more ideas to get higher valuations. It's a bit of a challenge, but I think overall you need a combination of public policy, incentivizing smaller companies and medium-sized companies to list. You need a domestic demand base, and that means pension funds, but also domestic retail investors. Brazil has a big community and several IPOs that get placed fully in the local market. And also you need the common topics that were mentioned earlier about good governance and just think about us as partners, as Losner partners of capital.
Thank you very much. And Solange, let me start by touching on regulation, and I would like to use the UK as a reference. The UK is working on metrics to measure how regulation contributes to economic growth and efficiency. Does the CMF works on similar metrics, and could those metrics contribute to prioritize certain policies that you are thinking about?
Yeah, well, indeed, as I was mentioning before, we are working on this policy paper, and part of it is that what you don't measure, you cannot manage, and do not know if you are making or not progress. So indeed, it's something that we are focusing in a lot. But let me get a couple of points of what has been said, so we will not leave there going around. But the ecosystem, of course, it's very, very important. That's why I mentioned that's investors, that's also issuers, but it's also infrastructure and brokers and everyone. So we do need this ecosystem to really work. And it's a lot about details. And in terms of regulation, we do a lot of details changing, and in CCPs, for instance, and compressing for the netting purposes, or capital requirements. So we're all the time looking at those details. And whenever someone comes with something that needs to be changed in terms of a detail, and we do the evaluation, and we do the assessment, and we really understand what's the impact, and what's the risk? Because mistakes, of course, we can have a risk tolerance is something that we work on all the time as regulators. What's our risk tolerance in order to allow for mistakes? But mistakes can be really costly when you are working in the financial industry that's based on trust. So if there is a mistake and we really damage trust, we're in big trouble. So we have to be very careful. We need speed, but we have to be really very prudent at the same time with the changes. So we are looking a lot into details. We are working on it. We look at international standards. That's also something that's very important, because it's not just the assessment that we do, but also the assessment that third parties do. And we do have the FSAP, indeed. That was a very important piece of information, the financial assessment done by the World Bank and the International Monetary Fund in Chile, 2021. So that has different things that we have been doing recently in order to have a market that's more resilient and opportunities for development. That's something that we have been working on. We also have next month in Chile the Corporate Governance Roundtable for the OECD Latin American Corporate Governance Roundtable. So next month you will see some of it, where there is a lot of conversation in terms of what's being done in other countries, what works and what doesn't. The other thing that we do, and we're working more on it, is that every regulation, whenever a regulation is issued, it has to have an impact analysis. And we're working on improving those impact analysis ex ante, before issuing a regulation, but also ex post, because evaluating and really understanding what's the real impact of a regulation that has been already issued is something that we have to look at. Indeed, for instance, we have done a lot of changes in terms of trying to promote issuing in our country, more issuers to come into the market with easing requirements and automated processes, but that has not happened. So why is that? So that's the kind of questions we are asking. We work a lot also with the academia, because of course resources are limited, and so we have twice a year a call for papers on topics that we are interested in, and most of them of course aligned with evaluating the impact of policy. So that is something that we also do. So of course we do a lot of assessment ex ante and ex post, and we are trying to improve that as we move forward.
Thank you, Solange. Jorge, let me get back to the pension reform. Indeed, the regulator is working on the new benchmark and the new reference portfolio. Under your point of view, how should be the balance between domestic and international assets, given the limited availability of some local instruments? And specifically on that, are there any risk on asset concentration or pricing distortions?
Well, I don't know the answer to that, but I have a clue. First thing is that in general, the expression home bias is like a sin. People tend to hate home bias. But I think home bias is natural in the pension industry. And it's natural for a couple of reasons. First, most of the people are going to retire in Chile and want pesos. Second thing is there are asymmetries of information for local managers vis-a-vis international managers. And third, in such a cost-focused industry, managing local assets is cheaper than managing international assets. So I think at least those three things are relevant for the discussion. Then if you look at what has happened globally with pension funds, well, you have the extremes of the Netherlands that has probably 0% exposure to the Netherlands. But then you have, I don't know, Australia, 60-40. The US and the UK, 60-40 local. So it's not a clear answer. What to me is more important is to understand that, again, from a public policy point of view, whatever you end up doing with the regulation is not irrelevant to what happens to the local capital markets, and it has sort of been proven that having a stronger capital market helps growth, helps the availability of the process of assigning resources in the economy and so forth. So I think this is a broader discussion than just defining, you know what, this is going to be the benchmark, this is going to be 60% to global equities. It's much more complex than that, and it has a bunch of layers of decisions that have to be in the table. But going back to your original question, if, again, looking at broadly and even in very highly unsophisticated markets, there is a significant home bias in the portfolios.
Can I? Yeah, because I forgot to mention something in terms of pension funds. I'm not a pension regulator anymore. I was pension regulator for many years, so I'm pretty much aware of how decisions are made. There's no pension regulator here. Osvaldo's not here. I'm pretty aware of how decisions are made in terms of the pension fund regulator. But the pension fund regulator in Chile is part of the Financial Stability Council. So indeed, there is a concern in terms, and there is pretty much a need of the capital market for pension funds to work. There's no good returns if the capital market, the domestic capital market, is not working because there is a home bias. So it's not something that pension fund regulators do not understand. They do, and it's something that as Financial Market Commission, we participate on the Financial Stability Council, so we are following on the implementation of the transition for the target date funds. So just to everyone to be calm about it, we're looking at it, and we do know that there is an impact on the capital market, and we need the capital market to have good pensions, otherwise there's no good pensions.
Juan Pablo, you mentioned about taxes and actually the discrepancies between small and large companies. Given Nuam's regional perspective, how do you assess the impact of capital gain tax on market liquidity when compared to Peru and Colombia? And would you support its elimination as proposed by several market actors?
Yeah. The good thing is that all this conversation is related, and even your point about liquidity. No, the capital gains tax, as I said, has created this incentive to participate or not, or made it more cost inefficient to participate in the local capital market. But it has created a distortion between high liquidity stocks and low liquidity stocks, or even stocks that are going to come to market in the future. So it has created a differential cost of capital measure. So I think that I think there's broad agreement, at least in the industry, that the law that introduced the capital gains tax in Chile for high liquid equities needs to be revised, hopefully downwards, back to zero where it was, but more importantly, to make it broad in terms of access so that more companies can benefit on the reduced cost of capital, but more importantly, that we bring back to market a lot of the participants that left the market, particularly the retail investor and family offices. Family offices are great investors in the local capital market, but when they make the comparison on where to invest, net of taxes, they probably find better opportunities elsewhere. So we need to revise the capital gains tax, no doubt, in Chile to make it more competitive. Again, the competition is global. We can choose not to be competitive, but my point is I don't think we can have the luxury of not being competitive from that point of view. So definitely moving that direction would be important, but make it broad. Make it for every single company that is listed in Chile, and not just for local firms or high liquid firms, but to all companies listed in the capital market. And I just want to underline that I fully agree with your point about the role of pension funds in the local capital market. We've seen some very agnostic views of how the ideal portfolio for the new pension fund regime should be, and it's scary because they are the benchmark investor in the local capital market. They will be the drivers of whatever long-term financing we will have in Chile. So definitely getting that right balance correctly is going to be very important. So I would say the two pieces of regulation that are going to be more important in the next year would be capital gains taxation and the pension fund regime. And about risk-taking, I did not mean by any means that the CMF should be a risk-taker. I'm just saying that in the innovation process, for example, open architecture, artificial intelligence, all these things, we may get it wrong, but we should move forward. That was my whole point, not that we should be risk-takers all over. But about risk-taking, you also mentioned the preference of local portfolios today in fixed income versus equity. And I think what you were saying, to have better pensions in the future, we need to be more risk takers as a country, as a nation. So definitely more risk in those portfolios is definitely better.
Thank you, Juan Pablo. And Pablo, going back to you and also under your regional perspective, when dealing with Chile, what's your opinion on Chile's market infrastructure? I mean, custodians, trading system, even regulation. Are there any frictions that you face in Chile more difficult than other jurisdictions?
I mean, I think as I mentioned, the main obstacle we face is liquidity. How much of that is due to infrastructure and local rules? I think it's probably a small part. I think there are bigger issues to focus on. But we do face certain challenges, like when it comes to companies being able to buy back their own shares, which is, going back to the market maker point, it's a common, source of liquidity and of shareholder returns. It's very hard for companies to do that in Chile. I've discussed it with the few that have tried it or that do it. You need to commit to buy shares for I think it's an entire month, regardless of market conditions, exposing yourself, the company, to a lot of risk. And that makes the appetite for returning capital in that form and providing liquidity in that form quite challenging. I think in terms of disclosure, in terms of governance, Chile is not perfect, but it is above average, around the colorful emerging markets that we have to choose from. I think the bigger challenges we have faced are about institutional framework, had not been about the capital market regime in itself, but much bigger things like just rules of the game. Constitution, does it stay, does it change? That uncertainty is big. That creates a lot of risk premium that is obviously has diminished. And as long as we can have clarity on an overall public policy framework, I think that goes a long way for us to get comfort to invest in Chile.
Thank you, Pablo. Solange, In recent presentations, you have flagged the establishment of a market makers program to enhance liquidity. What specific incentives are being designed to attract and retain market makers?
Yeah, when we talk the repo market and market makers in the fixed income market, it's something that we have been working on together with the central bank and the Ministry of Finance. What we have worked most, it's in the fixed income market, because we do think that that can reduce spreads and costs of financing significantly. So that's a very good thing, and I think there's an agreement on that that can be done. On the specific details of what's being done, I cannot make any specific announcements, but that is something that we have been working. But there is also a challenge in terms of market makers in the equity market, and that's something that we can still continue addressing and looking at what the details there, because liquidity indeed is one of the problems that has been mentioned here in this panel. So of course that's something that we have to work further to, because tax incentives is I know the taxes it's a big issue and topic, but at least from the side of the CMF, it's little that we can do on that end. But there might be some other things that we can help with for that purpose. But specifically, we have been working on the fixed income market makers, but the details I'm not able to announce now, but we will, I think that soon enough, that's going to be something that is going to be shared.
Thank you, Solange. Jorge, you touch on investors. Let me touch a little bit on issuers. Okay, a key challenge is the limited number of companies actively issuing in the public markets. What reforms or simplifications do you think that should be considered to encourage more firms to issue bonds or go public?
I think the market, well, there are the obvious things, right? So you have to have incentives to go public. One of them is small caps, same treatment as large caps. But then you have to have another incentive, which is very important, and goes to your point. You have to make it easier, actually the word is possible, to close a company. The market should be both ways. In my previous life, when I was an investment banker, I tried to close a lot of companies in Chile. It's completely impossible, right? It's completely impossible. So you cannot, so there are a bunch of families that think that the stock of the company that they own was cheap. And they said, well, let's try to close it. It's not liquid enough. Impossible. There's no way of closing a company, because even if you're able to buy all the shares, the problem is all the dead people that have shares that it's completely impossible to buy them back. So that is something that I understand the reason why it's done that way, and it was sort of a sins of the past that ended up with this very highly protective capital markets for minority shareholders. That's fine, perfectly fine, but we cannot only do it that way. So that's one idea, right? The other idea is that I think you should be able to have a market that is sort of a shadow, a semi-private market, semi-public market, but companies that could do like a pre-IPO process, and that should be easier with information, and that also could help. There's one point I want to mention about market makers, though. Market making should be a business, and so there has to be an expected return for someone that makes a market. There have been efforts in Chile at some point in time to have market makers, and I can tell you from personal experience, it's been designed as a money-losing business, right? So this is important. It's very difficult to set up a market-making business for equities, for example, because you don't have enough liquidity. So a guy that has a bid for a block of shares will end up sitting on those shares for a relatively long period of time, right? So it's important to think about that and to think about that the market maker is taking a risk and he should have a decent reward for the risk that he's taking. It's not just trading in itself. It might be sexy in a way, but if there's no money involved, trust me, it's not going to work. Sorry, just wanted to make that point.
Thank you, Jorge. Unfortunately, we are running out of time. And this morning we heard a lot about growth, and capital markets is a true engine for growth. I would like to use 1 minute for each of you to, which are the main points of your presentation or things that you have shared this morning with us that we should prioritize to unlock our capital markets to ensure that we have enough capacity, enough liquidity moving forward?
I start? Well, I don't think there is a silver bullet, really. So there is a lot to be done, and many things have been mentioned here. In Chile, we do have challenges ahead. Of course, pension funds are big institutional investors, but not just pension funds. Also, in terms of the mutual and investment fund industry has grown a lot in our country. So I do think also that have institutional investors, not just pension funds, but also other institutional investors participating in the market, it's going to be key. But not just that, also retail investors. Today with technology, there's a lot easier to people to invest in financial instruments. That is very challenging because we do know that there is an important lack of financial knowledge. So that's something that we do have to look at it carefully in terms of have that investor-based participation so that we have also liquidity and a diversified set of investors in our market. And also on the side of the issuers, there is a lot to do. The squeeze out. We do have the tag along, but we do not have the drag along, and we do not have the squeeze out possibility really in the case of Chile. So there's a lot to do, I could say, and in terms of investors, issuers, and we'll be working on it in the next months. So can have a roadmap to move forward.
So the good news is we're going to be busy.
Of course, we will.
I will go back to my point about nurturing every single piece in the ecosystem. I think that the conversation is everything matters, and of course there are things that are across all sectors, and incentives are very important, as you mentioned. I think the incentives for the asset managers, not just the pension funds, insurance companies are a very critical, important participant in the market. The AGFs or mutual funds are also very important players. The funds that we used to have about small and medium cap companies, those were very important in the market. So incentivizing demand or making sure that the demand participants have the right incentives is going to be very important. And of course, the tax issue is across the board, both for the companies to want to come to market because it makes sense, their cost of capital will be lower, but also for investors to be here. So it's really about, let's have an integral conversation about the ecosystem. Every piece matters. Of course, there are certain issues that we need to concentrate on first in that plan. But I think that the goodwill of many participants today is wonderful. I think the invitation that CMF has done is a tremendous opportunity for the country. The pension reform is a tremendous opportunity. So I think if we all contribute, we will have a very good next few years.
I would focus on ensuring the liquidity of existing companies goes up, and that's through public policy that promotes derivatives, market making, buybacks, takeover legislation. I would make sure that the conditions are created for small and mid-sized companies to see the equity market as a viable alternative, as a viable source of financing. If you ask private equity funds invested in Chilean companies, what's your exit strategy? The answer will be M&A, maybe US IPO, local IPO. It's not a base case for pretty much anyone. How do you change that? And finally, developing the domestic investor base that will give liquidity to the long tail of high-quality companies that we currently can't invest in.
Well, I fully agree with this. I think the market is too concentrated. I think we need to develop a broader investor base. Regulation also can help around that. So flexibility on what mutual funds can do, flexibility on what life insurance companies can do. Those things would definitely be more important. So the market is too concentrated, we have to broaden it. And then the other thing is that we have this huge opportunity, right? In the next 18 months, we're going to have a new guidance for pension funds, and this could be really, really, really good news, or we can blow it. I hope it's going to be good news.
Okay, thank you very much. I invite you to the library to continue with the geopolitical panel.
Thank
Thank you.